Welcome to the last panel discussion of the day. It's arguably the most exciting. I'm Cowperthwaite. It's my pleasure to introduce two experts in China tech. To my right is Brian Chen. Brian is portfolio manager for the Clough Asia Fund. He has over 20 years experience in Asia Pac investments. To my left is Michael Kwon, managing director at Graticule Asset Management in Asia, and his focus at Graticule is consumer tech, internet. So without further ado, let me start with Brian.
Great. Thank you very much for that kind introduction. And thank you, George and Connie and the Society for having me speak today. Before I get started, I just wanted to let you know that I didn't choose the title of this particular track. So if you think I have the next Alibaba up my sleeve, you might be sorely disappointed. But hopefully I can point you in the right direction over the next 10 to 15 minutes. Just want to be sure here that we got the slides. Okay, awesome. Anytime I talk about China, I always like to start with some stories and some pictures. You know, I first traveled to China in 1985 as a student, as a college student, and then as a business person in 1991. And in those days, Shanghai, this is a picture of Shanghai, looked like this. You have the famous Bund in the forward part of the picture, and the Huangpu River, and then across was Pudong, which was basically a few buildings and some rice paddies. So in the mid-90s, I met with this company called Shanghai Lujiazui Trade and Finance Company, which was tasked with developing and helping plan Pudong. And they basically took me into a room with a model, a business model, a model of what their plans were for the upcoming decade. And it looked something like this. It wasn't this, but it looked something like this. And you can imagine, I basically said, hey, there's absolutely no way that they were going to be able to accomplish this. They were selling me snake oil. Well, lo and behold, about 11 years later, Pudong looks like this. And similar to in Shenzhen, which was a small fishing village just north of the Hong Kong border, was a fishing village in the early 1990s, and today Shenzhen looks like this. The reason why I like to share these stories is that what we've seen in China over the last couple of decades is unprecedented. And I think, and it's my belief, that China will continue to surprise. And that's why I'm particularly excited about presenting on the China semiconductor industry and its development. As many of you know, Chinese semiconductor or technology sector is actually quite well developed. One would argue that in the e-commerce space with Alibaba and JD.com is more developed than what we have in the West. We also have very developed social apps like Tencent and Weibo, as well as search and Baidu. But there's one area that China actually lags the West, and that is in a local semiconductor ecosystem. That includes IC design, IC production, as well as packaging and testing. Here at Clough Capital Partners, we focus on companies, sectors, and industries that have investment tailwinds. And in China, one of the most important investment tailwinds is actually supportive government policy. And as you can see in the top part of this slide, actually the Chinese government has been supporting the IC sector, or the semiconductor sector, since the early 2000s. But I think the most important statement was made in May 2015 when China's State Council announced a Made in 2025 China initiative. In terms of the long and short of it, from an investor's point of view, targets $143 billion in semiconductor sales in China by 2020. And as you can see here, that results in about a 20% compound annual growth rate in sales. So this is the area in which I'm going to be focusing on. I'm going to be focusing on the semiconductor ecosystem because since it's a nascent business, I think that some outsized returns can be generated. First, let's take a look at where China has come since 2000. If you look at China's IC industry revenue as a percent of global IC share, you can see it's gone up from 1% to 17%. Fantastic, fantastic growth. However, this is the problem for China, is the spread between consumption and production. And this is what the Chinese government wants to address. Why do they want to address this? Well, first of all, there's national security concerns. China wants to have its own domestic source of chips in the post-Snowden era. Secondly, from a labor standpoint, China no longer wants to, as the people get more rich, they don't want to do low-end manufacturing anymore. They want to move up the value chain. And finally, profit pools. You know, the profit right now, as semiconductors are being manufactured outside of China, they want to keep the profits within China. So why do I think China is going to be successful? Well, in my view, you have a perfect dovetailing of a number of factors. First of all, you've got financial and labor, financial capital and human capital availability. You have supportive government policy, and finally, you have access to technology. So let's take a look at where China is today in terms of human capital. As you can see here, these are kind of hard to read, but China right now produces the most science and engineering PhDs in the world. In addition, they have the largest pool of researchers. And these research are being put to work. As you can see, as a percentage of GDP, China's spending has been growing consistently. And there has been talk on a PPP basis that China's R&D spend is going to be greater than the United States. So what have they gotten for this money? Well, if you take a look at the bottom left, in terms of patent applications, China has applied for nearly double of what the US has applied for. In terms of granting, they stand second only to the United States. In addition, from a financial point of view, there's a huge burgeoning venture capital industry happening in China. As you can see from here on the right side, if you combine Beijing and Shanghai, it's almost as big as the Bay Area from a VC perspective. But more importantly, if you look at the trends, that's what we do as analysts, China in 2009 basically barely made the map. So you have a huge private VC industry, but also you have a huge public VC industry, i.e. the government. And this is the one that kind of intrigues me. This is the National IC Fund structure. And this is basically this fund was created and funded by the national government. And it has $21 billion in assets. And its key tenant and its key theme is to develop the national ecosystem for the semiconductor industry. Not only is the central government getting involved, but local governments are getting involved as well. Citigroup put together a great chart here, which shows $40 billion in local government semiconductor funds. So here you have access to not only venture capital, which we all know its role in developing of industries, but here's a chart. This is a little bit hard to see, but semiconductor companies also have access to low-cost loans, policy loans from policy banks. In addition, they have tax subsidies on the R&D side, as well as land subsidies from the local governments. There was a study done by our Hong Kong Foundation that estimates that actually these land and tax subsidies could be basically 23% of the industry's profits. So, with this combination of human, financial, and debt and equity capital, is China going to invest profitably? And this is kind of the question that I think we all have, because as we've seen in the cement space and the coal space and the steel space, they've overexpanded and overinvested in ultimately in money-losing industries. Well, China does have a bit of a track record. We do have some listed companies in the A-share and the H-share market. As you can see here, they've actually generated consistent positive ROEs over the last 5 years. And the pipeline of actual tech companies that could become available are actually quite numerous. As you can see here, the IC design space, these are IC design houses basically create the products that drive technology, such as your smartphone. And in 1990, basically there were 0 IC design houses in China, and today there are almost 650. And as you can see, the IC design house revenue growth has been quite phenomenal over the last 10 years or so. This next slide highlights the biggest players, and I think these are the companies that you'll see some very exciting news coming out over the coming 3 to 5 years. Some of them are listed, or some of them are part of listed entities, but this is where I would focus my attention. And as you can see here, where they are positioned from a market perspective, they're competing against the big boys. They're competing against the likes of Qualcomm, Broadcom, Infineon, Samsung. So the Chinese are there. So one other question that one has is that where is China going to get its technology? Where are they going to? Is it going to be from the IC design space? But as you can see here from this slide, China's actually been very actively involved in M&A. So this, I think, the first one happened in December 2013. But you've heard about China going out and buying, trying to buy out SanDisk or, memory companies. But this M&A avenue is actually becoming more difficult because of geopolitical concerns and the fact that the West doesn't want China to have leading-edge technology. But for example, SMIC, which is China's leading foundry, they just bought a company last year called L-Foundry. And L-Foundry was a European-based foundry that gave them not only IP, but a customer base in the automotive sector, which they were historically weak on. So in terms of addressing the profitability point of view, I mean, this is, I think the biggest concern and the elephant in the room. I think that we can take a look at, some of the behavior of the foundry companies in China. These are the biggest company, the two biggest foundries in China are SMIC, which is 981 space HK, and Huahong, which is 1347 HK. And if you look at their profitability trends, they've been profitable for the last 5 years. And when you meet with the management of SMIC, their product roadmap is designed to maximize return on invested capital. So in my view, this kind of reflects China's desire to build not only a world-class semiconductor industry, but a profitable one as well. But that's my presentation for now, and I'm going to hand it over to Michael.
Good afternoon, or good morning. Thanks very much for having me. My name is Michael Kwon. I'm here from Graticule, Asia. I also did not pick the question here today, but so when we received this topic for this panel of what is the next Alibaba, we had a lot of different thoughts about how to answer it. And I think I'll start with sort of defining it a little bit differently. I think what this group is really after is trying to find the next company or set of companies that can grow to $300 billion in equity value, which is what Alibaba is worth today. So my approach to answering this question will be a little bit deductive and try to re-examine the conditions that allowed the current Alibaba to exist and forecast whether those conditions can be repeated and where. So, Alibaba is a very innovative company. They've created a very compelling user interface that's helped the company dominate the e-commerce marketplace. However, it's important to recognize that there are two consumer megatrends that genuinely aided the creation of Alibaba. And one of them is smartphone penetration, and one of them is e-commerce penetration. For smartphones, Chinese penetration of smartphones has increased from about 12% in 2010 to over 80% today. What this has done is it's created exponentially more usage occasions for consumers to access Alibaba's properties. Additionally, on e-commerce, the share of e-commerce transactions has increased from 3% of retail sales to nearly 14% today, which is almost double what it is in the United States, as Chinese consumers have become more and more comfortable buying goods and services online. In my opinion, to find the next $300 billion in equity value, the most productive way, or the next Alibaba, the most productive exercise is to identify the next consumer megatrend that will allow for such value creation. And before we do that, let's just look a little bit deeper at the current situation and where the Chinese consumers spend their time and money. A hint, it's on Alibaba and Tencent. Chinese consumers spend roughly $670 billion a year today online, of which Alibaba accounts for an overwhelming 80%. In context, the US e-commerce market transaction value is about $400 billion today. Now, we expect that the e-commerce market in China will grow to 1 to 1.4 trillion, depending on what assumption you use for penetration, 14 or 20%. in 2020, and this is significantly above other key user end markets that are addressed by public equities in China, like online travel and online games. Now, where do they spend their time? Here, let's introduce another China tech company that is a peer of Alibaba named Tencent, which is also north of a $300 billion equity value, many thanks to their WeChat platform. On the right here, here's just some key metrics about usage on WeChat, a platform that represents over 90% of China's 4G smartphone users. I just want to highlight the one statistic here that shows that over 40% of WeChat users have already linked a credit card to that account. That'll be relevant in a few slides. So, this is the slide that sort of convinces me, and hopefully convinces you, that it's highly unlikely for the next Alibaba or the next Tencent to come from anyone other than Alibaba or Tencent. And that is because the major consumer trends that allowed Alibaba to exist, or at least one of them in terms of the smartphone cycle, is largely over now. We're at 80% plus penetration in China, and from this chart, as you can see, the user growth rates slow as you grow in penetration of a particular market. And just anecdotally, if you think about what you did when you got your first iPhone or your first Android phone, you probably scoured the internet and blogs looking for all these new apps that are interesting and cool that your friends have that you want to try and install, and you've probably installed 100 apps the first time you got a smartphone. And think about what you did the last time you got a smartphone. You upgraded your latest iPhone, you probably did nothing. All of your apps were already loaded, and maybe you had to update some contacts, but that's about it. The natural tailwind for new applications and services comes with the flow of new users, and that cycle is pretty much done. So that has created an incredible barrier to entry to the companies that currently dominate time and your wallet share, which are Alibaba and Tencent. So that's why we believe it is highly likely that the next Alibaba is actually going to be Alibaba. So remember this chart from 2 slides ago, 1 to 1.4 trillion US dollars in transaction value for the e-commerce market. It seems like a lot of money, but there's actually a much bigger consumer market out there in China, which is internet-enabled finance. Internet-enabled payments today is a $3 trillion transaction value market, and we expect it to be nearly 10 trillion in transaction value in 2020. Additionally, online finance products are expected to represent over 1.2 trillion in either loan value, wealth management assets under management, or insurance premiums. We think that the next mobile, the next e-commerce is potentially internet finance in terms of the impact to consumer behavior. So how do we realize the equity value from this trend? Actually, sorry, let me step back. If you notice on the right side chart, who happens to already be the dominant players in this growing market? It's Alibaba and Tencent. And why is that? It's when a platform like these two controls so much or accounts for so much of your time spent or so much of your wallet share, it's much easier for them to cross-sell you a new use case or a new service than it is for a brand new company to convince you to try them. 40% of WeChat users have already linked a credit card to their account, and it shows incredible trust on the part of that consumer base to conduct transactions on that platform. I'll also note that 75% of Alibaba's e-commerce transaction value is conducted with Alipay. Now, the left side chart just shows how meaningful this future opportunity is to Alibaba and Tencent as companies. These are not small markets that are available for them. We estimate the revenue opportunity associated with the $10 trillion in transaction value you saw on the previous slide and the $1.2 trillion in loan, wealth management assets, and insurance premiums is roughly about $65 billion US dollars in 2020. I'll show you how we get there on the next slide. But that is in comparison to what the Wall Street consensus is expecting in 2020 for Alibaba and Tencent's core businesses. So clearly the opportunity for them for this incremental new market is pretty meaningful. These are some of our assumptions sort of laying out the math of how we get to our market sizing. They're based on transaction value assumptions as well as online penetration rates. The most sensitive of variables in these equations are online penetration rates. And we believe that the rate of penetration for many of these use cases, whether it's whether it's online banking, think about how often you use a Chase or Bank of America app to transfer money now versus even 3 years ago. E-trade, think about how many of your equity orders for your personal account you do online versus 10 years ago when they were all over the phone. These shifts are also occurring in China at a very rapid pace. So, to sum it up and get to the actual market value potential, going back to the sort of the original question, we defined it as how to find the next Alibaba, or in other words, the next 300+ billion in equity value in the Chinese market, and this is how we get there. So we've identified that $65 billion in 2020 is roughly what we see as the revenue opportunity. And using what we think are relatively conservative assumptions for profit margins, we use margins that are below developed market peers, and valuation multiples, we arrive at a $455 billion market value for this industry in 2020, which if you were to discount that to present value is $360 or so billion, and poof, there's another Alibaba. So here's the fine print. As you know, standard practice for investing in China requires you to be highly vigilant as it relates to regulation, as well as competition with state-owned enterprises. In this case, they would be the banks. The estimates from this discussion are based on the current regulatory standards, which, as this market matures, may change, and they may change in either direction in favor of the incumbent system or the new generation. One other factor to consider is how Alibaba and Tencent interact with the current banking system. Right now, they are very happy to be somewhat of a third-party facilitator and partner to these companies, which has allowed them to avoid significant balance sheet expansion. This is the path, if it continues to the future, towards the highest returns and the highest margins for all parties, including the banks. However, as the market matures and profit pools grow larger, there is the potential for competition. And competition would obviously reduce take rates and reduce ROEs for the overall industry. And sort of the final point I'd like to leave you with is why we think the technology firms have a right to win in this market. And if you look at the right side chart, is a comparison of the number of bank accounts in China compared to the number of WeChat accounts. And we believe that, you know, China, as one of the countries that is underbanked, has the potential to drive incremental financial inclusion by incorporating the technology firms, which have found a way to reach a broader subset of the population than the traditional banking sector has. And obviously, the consumer is spending so much time and so much of their wallet share already on these platforms, the barrier to financial inclusion could potentially be lower to WeChat than it is for any traditional bank. Many banking consumers, or incremental new banking consumers in China, could potentially first have had a smartphone first and therefore WeChat first before a new bank account. And so with that, I'll leave it for any questions. Thank you very much.
Thanks, Brian. Thanks, Michael, for wonderful presentations. So let me start with questions on the semiconductor industry. I think the first question that comes to my mind is when you invest in semiconductor industry, you have to think about cycles. Given the industry has been a robust performer for the past 18 months on a global basis, where do you think we are in the cycle?
Well, I think that there's a number of ways to answer this question, but as it relates to China and the China semiconductor cycle, I think that there's, you know, just as Michael alluded to, you know, if you look at smartphone penetration, it's very high, but because of the government's desire for the development of a domestic Chinese semiconductor industry, in some ways it's isolated from, I think, some of the global, you know, pulls and tugs from smartphones and servers, et cetera, et cetera. So I think that there's a structural reason to be bullish on, you know, semiconductor production and design, as well as packaging and testing in China, because they want to bring things in-house. And as we know, you know, just as I showed you what China can do on the real estate side and the city development side, I think we cannot underestimate how important Chinese semiconductor industry will be globally, probably in the next 3 to 5 years.
What do you think the risks are involved in investing in the Chinese semi-industry?
I think that, I tried to touch base with it, on it during my presentation, but the risk is that the Chinese spend too much money and they're inefficient utilizers of capital. And, we've seen them do it in a number of industries. But I think that given, the two companies that I had mentioned earlier, SMIC and Huaheng, actually have large government shareholdings, and the fact that they've been profitable for 5 years, and the fact when you meet with management, they talk about capital discipline, positive return on invested capital. This is terminology that, from an investor point of view, is music to our ears. So I think they're going to be, the risk is that they do it haphazard and lose investors' money and lose money, but I think that they have their act together in this particular sector.
If you think about the Taiwan semiconductor industry that started 30 years ago, I think it took Taiwan Semi probably 10 years to come to its own. How long do you think that we will see the emergence of Chinese semiconductor industry, the winners, to emerge?
Well, I think you can see some of the players that will be important participants. And if you look at the market cap, its valuations of, some like a Huaheng or a SMIC, they're minuscule compared to TSMC. In terms of the timing, I think that, if you look at their product roadmap, TSMC is way ahead of the game. They're probably 3 to 5 years ahead of the Chinese, and I don't see them narrowing the gap. But the fact is that, does China need the leading edge technology? Probably not. But they are going to be building, second or third generation and even lagging capacity, but bringing it once again onshore. And from an investor's point of view, there's a huge profit cycle that could be available to us.
Who do you think the winners and losers are in the semi?
Well, I think that, from on the production side, you see, I mentioned a couple of companies, but on the private side, there's a number of private companies. We know about Huawei, which is the largest telecom company in the world, and they have this IC design house called HiSilicon, and HiSilicon actually just brought to market a application processor, which is basically the brains of the phone, that matches the metrics of the high-end application processors that Samsung has, as well as Intel. So I think that ZTE has a IC design space. I think these are the kind of companies that will succeed going forward.
Thanks, Brian. Yeah. Does anybody have any questions on the Chinese semiconductor industry? Thank you, Brian. Okay, now we shift to fintech. So Michael, when we talk about fintech, we've already seen some of the couple of new listings of Chinese companies in the US, and they're primarily in the P2P lending space. I was wondering if you can shed some light on your thoughts on P2P and the risks and characteristics of this market.
Sure. P2P, meaning sort of consumer-to-consumer lending, is an interesting market, but it is not nearly the scale of business-to-consumer lending or small business lending or consumer lending. So while that may be a niche of the market that could be captured, I don't think the take rates available in consumer-to-consumer lending, as well as the credit quality, make for what I would call a megatrend market, whereas consumer lending, business-to-consumer payments, consumer-to-business payments, et cetera, those are trillions of dollar markets with marginal credit quality risks compared to C2C lending. So the risks are that you are investing in such a company at the height of an economic cycle, and the model is not clearly tested for what happens when you pass that. whereas I feel that in the more traditional prime finance areas, all you're looking for is not creating a new business model of going around the banks, but creating a new user interface to how to interact with the traditional banks, which is what Alibaba and Tencent are doing.
When we talk about Chinese fintech, obviously we have to be cognizant about the regulatory environment. With regard to fintech, can you just talk about the potential risks when it comes to the regulation and the current environment?
Sure. The risks are that they may change, and I guess our presentation is sort of based on what the current standards are. Everything we've read from the state, as well as from the companies, both the incumbent banks as well as the new companies, seems to say they're all aligned because internet finance increases financial inclusion, which is not negative for the state of China. But we don't know how that changes when this goes from a $3 trillion industry to a $10 trillion industry. There may be differences of interests at that point. But that's why I think I was adamant to include a fine print slide. But for now, there's no signs that there is competition versus cooperation.
How should we think about the valuation of fintech? Are there any other global companies that you can compare Ant Financial or Tencent Pay to? Sure.
The difficulty of comparing it straight to a U.S. company is that the system of how Tenpay and Alipay monetize is a little bit different from how, say, a Visa, MasterCard, or a PayPal monetizes. But I would say that PayPal is the most analogous, but for structural reasons, not the same end market opportunity. And PayPal does not participate in the areas of online lending or B2C lending, SME finance lending, it's wealth management distribution. They're really only in internet-enabled payments, which is the largest transaction value market of internet finance, but it's also the lowest take rate market and therefore the lowest margin market. But in terms of valuations, the way I think about it, and my attitude is growth is the most important variable, and I view valuation multiples as a reflection of the market's confidence in the stability or the sustainability of the current expected growth. So I believe that I would rather buy an expensive company on a PE basis where I have utmost confidence that they control their destiny than a company that is relatively cheap but has a lot of competitive and or regulatory concerns. In my opinion, because Alibaba and Tencent have established these giant walled gardens and the door has just been closed because the smartphone cycle is nearly over, if they're not the dominant players in internet finance, then something materially unexpected has changed in the market, in my view, which would be, in my opinion, sort of a black swan scenario and not a 10 or 20% chance scenario.
Well, since we're talking about China tech, I think maybe we can look at the bigger picture. Right now, when you think about on a global tech basis, a lot of the investments or the themes that are playing out on a global basis are artificial intelligence, machine learning, sharing economy, and content. How do you think the Chinese companies are positioned in these areas? Will we see somebody or some companies emerge as a global leader in these areas?
Sure. I think it's too, and I think Brian will definitely want to chime in on this question as well, but I personally think in the areas that I follow, which are more sort of consumer facing, it's too early to say on AI and some of those other areas who will lead and why they will lead. Because I think that AI is still searching for the killer problem for which it is a solution. And it could be Baidu, it could be Tencent, it could be Alibaba, or it could be that these companies use AI, machine learning, big data, as augmentations to their existing businesses as opposed to a separate packaged product to a consumer or to a business. And so far, I would say what Google is doing outside of China is using their vast amount of data, and that's sort of the key, who has the data, to offer better search results to their users, to offer more ROI to their advertisers, as opposed to a unique specific product that they're selling.
Yeah, just to add a little bit to that, I mean, I agree we're still relatively early in the AI development, globally. But the fact is that I think there is some agreement that the importance of data is a very important part of AI and figuring out what it's going to be used for. And if there's one country in the world that collects a lot of data on their people and on their habits, it's China. So, Baidu knows every search result. Hikvision knows where you are, what you're doing, and who you're visiting in cities. And so, if you talk about the amount of data that China's collecting, I would argue that their access is probably relatively unequaled, and particularly given the fact that there are 1.4 billion people that are there. So, my view is I'm relatively optimistic about the prospects, for the likes of a Baidu or Alibaba or a Tencent to actually be big players in this market going forward.
I mean, from my point of view, China has been an exciting incubator for great tech companies. Maybe Michael and Brian, you can touch on the private company side, what you're seeing as mini trend within the mega trend, the hot sector for the next generation.
I'm actually a public equity guy, so I wish I could answer your the question specifically. But just to give you some highlight, if you look at the trends of the performance of MSCI China or FXI, basically the stock market's basically done this from 2010 to 2017. It's been very difficult unless you buy low and sell high to have made money. But if you look at underlying some of these A-share companies that that have basically surpassed their 2015 highs during the speculative bubble. You've got tech companies like Hikvision, which is at one time just camera vision. Now they're getting into AI. They're getting into smart intelligence and growing very rapidly. You've got a company called MID, which basically is one of China's dominant white good manufacturers, but they actually acquired KUKA, which is a factory automation play out of Germany. And so there are a lot of these public companies that are at the forefront of China's AI development that you're getting at relatively attractive valuations. So I think that the A-share market is really exciting from my perspective.
I pass to Brian to think of my answer for privates. I'm also a public equity investor, but I guess I would sort of go back to the slide about smartphone penetration versus user growth rates. And if I were an early round investor, a private investor, an IPO investor even, the first question I would ask any company that comes across and says they have something that is interesting to consumers is, how are you going to compete against Alibaba and Tencent without the natural inflow of new smartphone users? Are you going to lose a lot of money to try to convince a smartphone user who already has hundreds of apps on their phone, here's one more new one for you to try? And as the market has gone more and more penetrated and less new opportunities to get users, I think there should be a negative correlation to how much VC funding there is in that particular ecosphere. Now, that's not to say, for example, we were talking in the hallway about Toutiao, there's not to say that interesting companies with unique use cases can come up, but I don't think that Toutiao will be a $50 or $100 billion company. However, they have found a very unique and revolutionary way to provide the news to you in a customized format, and that's the one I think sticks out as sort of recent, as you call them, mini trends. I would agree with that. But as an earlier investor in this particular ecosystem, which is internet software application services, I would be very skeptical or at least I would be much more skeptical today than I was, say, 3 or 4 years ago when we were at 50% penetration, about a company's prospects to gain a significant user ecosystem at this point.
Thank you both. Do we have any questions from the audience?
I have a question about the IPO process. Private Chinese companies, when they go public, first of all, do they want to go public in your experience? Do they need to? And do they prefer listing in China, in Hong Kong, on the NASDAQ? How do they think about that issue? And do you think we're going to see more companies listing on the NASDAQ?
Well, frankly, the company that I spoke to in my presentation is probably the next major listing, which is Alipay. Just a reminder, Alipay is, right now, Alibaba receives roughly 35% of the net income of Alipay, which is zero, because they're investing behind growth. At the IPO, that will transfer to a 37.5% equity stake. So that's how you play Ant Financial / Alipay through Alibaba. Tencent owns 100% of its payments business. But Alipay will probably be the next listing. I think some people thought it would be this year. It's probably first half of 2018. And I think they, like everyone else, unless you are particularly concerned about voting rights, which is what Alibaba was concerned with and why they tried to list in Hong Kong the first time. Outside of that concern, I would think you would want to be where you can get the highest valuation, which at one point was the A-share market. And I'm not super familiar. I know that the relist or backdoor list market has sort of narrowed and, if not closed, but in terms of new issues, I'm not sure if that's been closed as a route. But I would say whoever's willing to give the highest valuation.
Just to follow up on Michael, because obviously we've been very active investing in A and H market. The IPO pipeline has been very slow. So if you remember Qihoo, who took themselves private to relist in mainland in A-share market, I think the timeline we're looking at is 2 years. So with that being said, companies that are still willing to wait to get higher valuation, they're waiting. But we are seeing quite a few Chinese companies listing NASDAQ. I mean, even though they're definitely on the smaller cap size, so you might not be familiar with. Just, on the fintech side, we have China Rapid Finance, who just got listed, and then we have Yiren Dai, who got listed maybe a year and a half ago. So I think there are quite a few that are willing to come to NASDAQ. No questions? Well, I'm going to put Michael and Brian on the spot to ask what your best pick is for the next 12 months or for 5 years. So short-term pick and long-term pick.
Does it have to be in China?
Since we're talking about China tech, I think we're limiting ourselves to that universe.
Sure. I personally think in the universe of companies that I follow in China, it's definitely Alibaba. And some of those are micro analyst reasons, and obviously the macro reasons are that e-commerce penetration is still increasing very steadily. Alibaba and JD.com have dominated the market. There's no incremental competition. And what Alibaba is doing in the near term is they are finding ways to incrementally take budgets from other advertising mediums like Baidu and getting advertisers to spend on their platform, which is enhancing their revenue streams beyond just the selling of e-commerce goods. That's a new revenue stream that has emerged very recently for Alibaba, in addition to which they have other what I call call options in the near term with cloud computing, digital video subscriptions, etc. Over the next 5 years, however, I would probably pick Tencent, only because I think internet finance will be the 5-year story for these two stocks and for the sector, and Tencent owns 100% of their internet finance business, whereas Alibaba owns about a third.
I'm going to stick with SMIC 981 Space HK. I just think that the time for Chinese foundries is today. If you look at it from a valuation perspective, it trades right now at a slight discount to book with an improving ROE trend and margin trends that are also improving. So, and I think that from a market positioning point of view, SMIC will continue to gain share domestically. And I mentioned this Foundry acquisition. The automotive space is not an area that they've had any exposure to. And with China being the largest auto market in the world, I think that SMIC has a wonderful opportunity to bring European IP into China and penetrate that market.
Thank you. Thank you, Brian. Thank you, Michael.
Thank you to all of our speakers, including those who crossed the Pacific to be here, and to all of you who gave us a morning. We really appreciate you getting us launched in our China discussions. Besides the two perspectives that we include in the title, we'd also wanted to hear from actual practitioners who, of course, are held responsible for their decisions. And practitioners are those that are even harder to get. Pry away from your desks. We really appreciate that you're here. We also have 3 other groups to thank in particular. First is the wonderful team at the CFA Society in Boston. With them, nothing is too much trouble. Nothing's ever overlooked. That happens over and over again. They are wizards. The second group is the conference committee, which includes George Hoguet, but also Bill Lee, investment officer at Mass Prim, and Pam Yang, senior vice president at Harvard Management. They were an unfailing source of wise counsel and really good ideas. On a personal note, it was a great privilege to collaborate with all of you. And the third group is the CFA Institute, the global organization. They made funds available and will produce a video of this conference. It'll be available to all of us and also to CFA societies and other organizations worldwide. We're very appreciative. So thank you again, and we look forward to more discussions about China.